For more on the markets, let's welcome in Mish Schneider, Chief Market Strategist, MarketGauge.com. Mish Schneider, great to see you. Thank you so much for being with us. We want to talk about the market first. I want to get your feeling. I mean, we have a mixed market. You see the NASDAQ soaring, even though the 10-year and the 30-year yields are surging. But the NASDAQ is having a beautiful day today, of course. I mean, you can put Palo Alto in there. But tell me a little bit about your big picture on the market.
Well, Nicole, you're absolutely right that the classic relationships that everybody has banked on has proven to be completely distorted this year, and you can no longer bank on them, ergo growth stocks and interest rates, right? So I think right now we're looking at August. Seasonally, it's generally weak, and we've had a nice correction. And at this point, when we look at our risk indicators, which often weigh how the market is doing, risk on or off based on how the long bonds are doing, we're still in a risk-on environment with one little teeny caution maybe emerging with gold, possibly starting to outperform the S&P 500. So for us at this point, as long as we hold basically Friday's lows, particularly in the Russell 2000, we like to really use that as our major index gauge, cautiously maybe creeping back into the market, but really still taking it easy as we get through the rest of this month.
As you talk about risk on, you do like some areas such as semiconductors, right? Tell me about some of the types of investments or even names of investments that you think could work.
Well, semiconductors, of course, unless we have some major event like China, Taiwan, that kind of thing, short of a major event like that, they are really doing pretty well, all things considered, on this sell-off, and even to H. It's getting back close to that 150 level, which is pivotal. And we have been in Nvidia for quite some time, really since February. So we're not looking to add before the earnings, but we do believe that at this point, just looking at the chart, without looking at any of the analysts' expectations, it looks strong. And if it gets through 480, that can continue to go up. So yeah, semiconductors will do well, like I said, unless we have some watershed event. In terms of the rest of the market, I'm really still interested in commodities. I have not changed my mind. I still think that the inflation narrative is here, not necessarily in all pockets, but we have wage inflation, we have supply chain issues, we have weather issues for sure. And so we're looking still at a lot of the food areas. I know you get information like India cutting back on exports for onions after they've just done it with rice. So we think that that's a big point, and it looks to me like silver is starting to pick up here and gold, and I don't think that they should be discounted. Other than that, we really like commodity-based names.
Yeah, understood. And then if you were doing something a little more risk-off or being more cautious, where would you put your money to work there?
I actually really starting to get interested in the whole biotech space in the portfolio. But even just looking at the ETF, IBB, and its top holdings, if you take a look at Regeneron and Amgen, Vertex, they're all doing pretty well. Biogen is a little bit undervalued right now. Looks like it could be bottoming. So we're watching that. I think would be a good, because whether we're risk off or risk on, biotech, of course, can do better. And now we're getting seasonally into where people could start getting sick again. And I know they're trying to boost vaccines for COVID. So just looking at that from a straight technical standpoint, I think that's probably a good place to go as well.
Right. I mean, it doesn't seem like a real safety trade, that's for sure. When you look at biotech, maybe something like consumer discretionary, home builders, there's just some other things you were looking at. Where do those fit into the portfolio? Why those groups?
Well, consumer discretionary, probably not my top. I would say more consumer staples if we were going into the consumer area. And in terms of safety play right now, really in the whole equity space, I'm trying to pick and choose here. But I really do believe that we're looking at another uprising in certain commodities, particularly in energy, which we haven't even mentioned yet. And like just looking at something like natural gas, which has been desperately trying to hold on here, that could emerge. And of course, anything to do with that like LNG. But yeah, biotech has done very, very well in spite of everything. So it could be cyclical and non-cyclical.
Yeah. And what about, you mentioned the Russell. Tell me about small caps. Do they fit in your portfolio?
Well, right now we're aside in them, but I think that they're an incredible indication of where things are going. So if you look at the Russell 2000, I mean, even in this whole rally, it got up close to about 2000, wasn't able to get through it. We thought it was going to cap out at 1950, so, went up a little bit higher. And the same thing with the downside right here. If they can hold on really at about 1800 right here, then I think that that would show that the soft landing may not be so. The market can absorb it, and that the retail investor is still very much interested in getting in. And the small caps would actually indicate maybe some kind of an infrastructure, manufacturing, industrial growth as we get into 2024.
I know everybody's watching real rates and inflation has come down in the big picture, but do you think that the Fed will raise in September and or November?
I actually think they'll raise in September 0.25%. And I think it's because they're going to be looking still at the labor market, which is really strong. The housing market, even though you see a lot of stories about a crash coming, prices are still extremely high. And they're going to look at the current CPI, PPI, and when we get the PCE numbers, and they're going to see a little bit of a rise in inflation because I don't see any reason why they wouldn't continue to be aggressive. What happens in the next 6 months after that remains to be seen. But for now, I'm going with a 0.25% rise in September.
Yeah, and so far earnings are better for the most part than anticipated when you look over the year. And some people are still waiting to hear from Nvidia, for example, on Wednesday to get a sense on tech. Where do you stand on watching as a final thought here?
Well, we know that it got a little overzealous and oversaturated, and that's what any critics of Nvidia are saying at these current levels. But I think that in terms of tech, regardless of what happens, even as you said in the very top, which was that the interest rates don't seem to be affected, it is definitely in its own fumes. And of course, AI is not going away anytime soon, and we're not the only country developing AI. Even China bought $5 billion worth of chips from Nvidia a couple of weeks ago. So, yeah, I think the future for tech is good. I mean, buy opportunities would come at dips. I wouldn't chase strength, though.
Right. Mish Schneider, great to see you. Thank you so much for being on with us today. Mish Schneider of MarketGauge.com. Thank you.